Thanks again for coming to the meeting. This is our first stock pitch for 2019. We'll go through the introduction, we'll go to the goals, the investment process, mentorship program, and so on. We'll try to keep this quick so we can actually get to the pitches. The introduction is this fund was founded in 2015, and it's a collaboration between the Bridge and the students and the Department of Management. We started with 250,000. I think we're now about 280,000. And we have three main portfolio groups, which is the consumer, our financial/technology, and our natural resources group. And you'll be hearing a pitch from each of them on a specific company tonight. And we've added, I think, a tangible amount of value to the student body. Our students have done co-op terms at companies such as CIBC, Scotiabank, and BMO. The vision for the fund is career development first, experiential learning second, and mentorship third. We want our analysts to take something away from the program and to be able to move forward in their careers in a way they like, and we'd like to mentor them to be able to kind of achieve their fullest potential. A lot of the more senior students have gone through the processes, so we like to help our junior students go through that as well. The student managed fund structure is we have the board on top, then we have the co-presidents and CIO. The co-presidents are Omar, who's here tonight, and Ruby, who couldn't make it tonight. And then below them are three portfolio managers, and each of them manage three analysts, and together each group, as I said before, will be paid stock. The strategic imperatives that we focus on for this year is to increase openness to the general public, and as you can see, that's one of the things we can see here tonight is in the past years, our pitches have been very private, limited to members and board. This year, we've tried to open it up, so you guys are here today, and we also have a live stream going on to Facebook Live, so anyone can tune in. The second one is improved connection with the first-year students, and we'll talk about the mentorship program in a minute. And the third is to improve board involvement, and we've tried doing that by being more communicative with the board going forward. The investment objectives are to maximize total return, as any fund should do, is to mimic the weighting of the TSX Composite Index. That's to give a feel that you're managing a real portfolio in the real world, and to diversify portfolio to minimize risk in the portfolio. So the investment selection criterion, which you'll see play out in the pitches tonight, is strong free cash flow and balance sheet. We want a strong, solid company. Steady capital returns to shareholders. We want a company that's actually caring about their shareholders and engaging with shareholders. And we also only focus on mid to large caps, so we don't focus on the smaller companies. And that's somewhat to do with our restriction staying within the TSX Composite Index. Our performance since inception has been up 12%. Over the past year, we have underperformed the S&P TSX Composite Index, and this year we're hoping to catch up, and our objectives for this year, as I talked about before, is really about getting us there. And what we're looking for going forward is to hedge against possibility of economic slowdown. As we've been hearing over the last year, there's a lot of uncertainty. We've been on a 12-year bull run at this point, and people are really looking at their portfolio and seeing how they can diversify risk and be in a better place. Secondly is to seek out fundamentally strong companies, and that kind of goes back to our first point, which is that we're looking for companies that even if there is an economic slowdown, they'll still be able to perform and return value to shareholders. And thirdly is to source bets with asymmetric upside. And that's really about if we feel that there's a potential catalyst coming up in the next year, we look at those companies to say, is there a bet here that more times than not will pay off and less times than not will not pay off? And some of the companies we're looking at, which you'll hear about today, two of them you'll hear about is Torex Gold and Cogeco. And getting into the mentorship program, it's basically so if you're first year, second year, or even third or fourth year, and you'd like to get some mentorship and you're interested in working in finance, you can apply to the mentorship program. We'll have a form up on our Facebook page, and you basically apply, tell us what you're interested in, and if you're interested in a specific role, such as sales and trading or investment banking, and through that form, we'll match you up with a member of the fund, and you'll basically have a one-on-one relationship. You can ask your questions like, how do I get into this role? What does the recruitment process look like? How do I improve my resume? And they'll basically be able to help you. And it's also a great way, if you're not in a part of this, if you're not currently an analyst, If you make this connection through the mentorship program with the fund, then next year when you apply, we already know you and you have a better shot of getting in. And some resources you should look at are obviously the bridge. We have a lot of resources. We have Bloomberg terminals. You have access to Capital IQ, FactSet, and Finance Lab assistants are always here, and bridge assistants are always here to help you. And we also have some websites listed, some YouTube channels, and some news sources that you can follow. And now getting into our first pitch, Kojiko with Cajun Soup.
Can we just hold on 1 second?
Sure, of course.
Yeah, no, they're just about to start their pitches, so let's do that. Okay.
No, that is definitely not making control.
Yeah,
Okay, I got it. Oh, you got a second. Okay. Let's go back to the start. All right. So yeah, we'd like to start off by introducing ourselves. My name is Cajun. I'm the portfolio manager for the Technology, Media, and Telecom Group.
My name is Brian. I'm the analyst under Cajun.
I'm Marius. I'm also another analyst working under Cajun.
And my name is Sai, a research analyst under Cajun as well.
Yeah, so we'd like to present our buy recommendation of Kojiko Communications, and we have a price target of $132. So yeah, our price target of $132 represents an implied upside of 15% from the current stock price of $115. We're recommending Kojiko because it's a stable company in a defensive sector and has a strong history of providing dividends and share buybacks. And Kojiko also continues to enhance its existing services with new technology that meets customer demand, and this is in the form of faster internet as consumers demand more internet at faster speeds. They're making their speeds faster to accommodate this demand. They've had aggressive growth and geographic reach in the U.S., and they've primarily done this through acquisitions of FiberLight and MetroCast, and we'll get into these acquisitions in a few slides. And they also have strong financials, and this is demonstrated by the profitability that they've driven through organic growth and acquisitions. So on the top left, you can see our football field, and you can see that we've used 3 valuation methods for the company, and this includes a DCF, a price to earnings multiple, and EV to EBITDA multiple, and we'll get into each of these afterwards. And you can see the historical price performance of Kojiko, and they've had a very strong year, one past year, as they've strongly outperformed the S&P TSX and the S&P TSX Telecom Index. They are, as I mentioned before, they're currently trading at $115, and they have an enterprise value of just over $9 billion. In the past year, they've had just over $2.3 billion in sales, $1.1 billion in EBITDA, and $415 million in net income.
Yeah, to just go over a bit about what Kojiko actually does as a company. So they're a communications corporation, and they operate within two segments, which is the Canadian American broadband service. So Kojiko operates in Canada and United States, with the Canadian side of the sector working on the Kojiko Connection, which is the second largest cable operator in Ontario and Quebec, and the United side working under the Atlantic Broadband Services, which is operating in 11 states across the United States, mainly on the eastern borderline from Maine all the way to Florida. So below you can see a service breakdown of their services, which include video, internet, and telephony, with video service contributing to 46% and a huge portion of their overall customers. So to go into some of the management and the governance about the people running Kojiko as a company. So Philip Jate is currently the CEO of Kojiko, and he was appointed in 2018, and he's had extensive experience in the industry with over 25 years in the telecom industry, and he's had previous employment at Bell Canada, where he held leadership experience and was in a senior executive role. Luke Noiseau is also the Kojiko's Chief Technology and Strategy Officer, and he's been in his position since 2016, and previously he held positions at Nortel and Nokia, and he's had extensive experience in expanding his position in Nortel and Nokia, geographic expansion into new markets, and he's hoping to be able to kind of assist Kojiko in that, in their expansions currently into the U.S. market. So the top institutional holders for Kojiko include Lyco Rosso, Fidelity Asset Management, and Manulife Investment Management. And Rogers Communication also holds a key 31.6% inside ownership stake. of Cogeco, which has stayed relatively consistent over the past 5 years. There hasn't really been much of changes in the amount they own, except with a huge increase in ownership stake in 2010 when they bought another piece of Cogeco. And this is kind of investment vehicle for Rogers, as they hope to try to go kind of into the more into Quebec as Quebec segment, which I'll be talking about later inside the corporate timeline. So the geographic segment you can see on the top right of the slide, with Canadian broadband attributing to 56%, and Canadian broadband attributing to 56%, American broadband attributing to 44% of the raw geographic segment in Canada and the United States. So Cogeco was actually founded in 1957 by obtaining a broadcast license to operate in Quebec, which was issued by CRTC. And they also IPO'd in 1985 by being a publicly traded company, and the cable business was also IPO'd in 1993 at $11.50 a share. So recently they have had two major acquisitions, which Peter mentioned earlier, about Fiberline and MetroCast, which we'll be expanding more about later, which allowed them to expand their presence in the United States, and they're going to be continuing that. And management has planned to continue the CapEx into increasing the footprint in the US region.
So this chart shows the movement of Cogeco stock price starting from the beginning of 2017 to now. In the middle of 2017, around July, there's a relatively large increase in the stock price, primarily due to the fact that Cogeco announced an acquisition of MetroCast and its cable operations. This was reacted positively by the market as it represented Cogeco's commitment to expanding its network footprint within the US. This acquisition allowed Cogeco to expand its presence to a total of 11 states. In 2018, throughout 2018, the share price declined with a noticeable steep decline within the first 3 months. This is due to the fact that Cogeco experienced customer management system issues, which led to a decrease in internet subscribers, and that contributed to consecutive declines in their primary service units. On top of that, at the time, Cogeco had a data center business which was not performing well, and there was no sign of momentum or turnaround in making sure that data center was going to perform better. And in 2018, Cogeco also purchased spectrum licenses, which usually indicate that Cogeco is gearing up for an entrance into the wireless space. However, this wasn't really reacted positively by the market because they believed that Cogeco was spending too much resources and money for a potential entry that might not end up being profitable. In 2019, the stock price went up. The year started off with Cogeco announcing the sale of their data center business, as it was producing minimal free cash flow and showed declining EBITDA. So the sale allowed Cogeco to focus on its core broadband operations and use the proceeds to fund potential acquisitions and delever their business. And they also reported strong financial results. They showed improvements in subscribers because they fixed their customer management system issues that was experienced in 2018. And they consistently showed strong US organic growth.
So now we learned a little bit about the company, so I'm going to the 4 points on why we should invest in this company. So one of the points being that this company operates in a very defensive industry. In the telecom industry, it's a defensive industry because that internet will be used regardless of what business cycle and economic cycle we will be in. And it also delivers a very strong dividend of 10% CAGR growth from 2016 to 2020, which allows a company to return some capital back to the investors for committing capital into this company. And this company also has positioned itself to be competing with the large incumbents in the industry by acquiring fiber optic business and integrating that into the business. So we believe that in the near term, in the future, the demand for internet, for speed and consistency will be increasing as the industry grows and as the technology matures. This company also has a very positive business outlook. we are seeing that there's very high demand for speed in internet. So that's why Culture Code recently had increased its services to offer 1 gigabyte per second internet to its customers. So then customers can use the internet service to fit their appetite. And there's also launching its IPTV service in Canada as an alternative to its traditional cable TV service. So this is because of the increasing internet trend of having all your entertainment to be viewed using internet, like for example Netflix and your Disney Plus. So this will be a similar service to that. And another one is that there's currently a bill from the government to approve Cogeco as a mobile virtual network operator. So then after this bill is passed, if this bill is passed in March of 2020, this company will be now operating in cellular services as well, in addition to its broadband services. So I know that 5G is the hot topic right now in terms of internet, and we will see that Cogeco will be slowly moving towards that area as the technology matures. And moving on to the financials part, we see that Cogeco has very strong financial performance. In 2019, the free cash flow grew by 50%, driven from its increased EBITDA growth and also decreases in tax rates. The proceeds that we have mentioned earlier from the divesting its business, it will be used to deleverage the business so that it can focus more onto growing this current business in organic and inorganically, so that we can continue to deliver all these strong performances. And in the US, I've mentioned earlier, has a very strong performance, and in its prime services unit, and it's established itself as a core consolidator in offering all their businesses and services to non-metropolitan areas. So as we see in the top right chart, we said there is a very consistent growth in sales and EBITDA, and in the bottom we see that in the US customer statistics, the customers are growing every single year. And we see that in 2018 is a big jump because of the acquisition that we had of FiberLight.
So Cogeco operates in the wire telecommunication industry. As you can see in this chart right here, it is expected to grow at an annualized rate of 1.2% until 2024. Within the industry, demand and revenue from the wire telephony side of the industry is expected to decline, and expected to decline due to the fact that customers are switching from landlines to wireless services since they can use it on their cell phones. However, business customers are expected to keep their landlines due to the high reliability, since businesses are more complex and are larger in size. So we believe that as the number of businesses grow, the demand for fixed land telephone services will grow as well. On the other side, broadband internet is the demand for broadband internet, which is high-speed internet, is expected to significantly increase. This is because customers are viewing high-speed internet as a necessity rather than a luxury. This is because they're using it for streaming services, and many handheld entertainment devices require high-speed internet. Also, between the two countries, there's a huge discrepancy between internet service accessibility between rural and urban areas, and Cogeco is focusing on providing high-speed internet to non-metropolitan areas and underserved markets within Canada and the US. In terms of competition in both countries, the market is dominated by few large players, and as they compete on price, quality, and service. A common trend is that they're bundling their services into one package, and although this decreases revenue per subscriber, they can achieve economies of scale, which actually increases the profit per subscriber.
So let's go into some of the key financial items that we broke down. We broke it down into 5 points. So the first is that the American broadband recently beat expectations of the market. So the revenue grew 7% year over year to $264 million, and the EBITDA also grew 5% year over year to $160 million. Subscriber metrics were also doing slightly better than expectations, with gains in internet and video of 2.5 thousand and 5,000 respectively. So they also lowered leverage on their balance sheet after the ICT transaction closed of the Cogeco Pier 1. Their leverage has dropped to 2.6 debt over EBITDA, and the management kind of expects this to further downwards to 2.2 in 2020. And we believe that this will kind of allow the company with even greater flexibility and ability to kind of pursue different additional U.S. cable acquisitions, which management has stated that they are looking towards. The Cogeco also has high long-term debt, with 75% of the total liabilities coming from long-term debt, which is not uncommon in the telecom industry, and we see this in play with some of the other industry leaders, such as Rogers and Bell. And the dividend payout ratio is also very, very high, with a 5-year average of 30%, allowing investors to kind of have consistent high yield on their investment. So lastly, they have strong financial ratios. As Cogeco has seen its financial health and stability strengthen in the past year, with increases in current ratio from 0.48 to 1.75, and the decrease in debt equity ratio of 1.92 to 1.54 in the past year, respectively. So in the two graphs below that, you can see the performance of the industry, with Cogeco outperforming the industry median, majorly in EBITDA margin by about 17%, and as well as you can see the strong financial position with the current ratio compared to the comp average of, for example, 1 multiple higher than the comp average in current ratio.
So let's go into some of the details on the M&A transaction. So Cogeco has very specific details on which companies to invest in or to acquire. So some of the guidelines are, so they have to fit in the strategic fit of the company, and also has to expand on a geographic reach on targeted areas. So and Cogeco may engage in divesting parts of the business that are no longer part of the strategic fit. So then the proceeds of these divestiture will be used to deleverage the business, will be used to invest back into the business to grow organically, and also perform share buybacks. So one of the recent ones that we have done is Cogeco was to divest its business, the data center business, to Digital Colony. So that was the first move that it made to divest its business, so that it can focus more on its strategic target of moving towards broadband services. And another one was FiberLight, which was done in 2018. This was a big move for Cogeco to expand into the east coast of the United States, because of this company operates in 44 key growth areas in East Coast, offering its fiber optic services in those areas. And before that, in 2017, there is a acquisition of MetroCast, which is a huge acquisition by Cogeco. This was the first entry, which was one of the major entrants to the U.S. In the recent years, which allowed the company to have access to more than 236 homes and customers in the United States.
Alright, so now we're going to get into the valuation of the company, and we're going to start off by looking at a comparables company analysis. So our main comparables are the major telecom providers in Canada, and this includes TELUS, Rogers, Bell, Québécois, and Shaw Communications. And you can see market statistics in the middle here, and you can see that Cogeco is somewhat smaller than the big three, of course, and somewhat closer in size to Shaw and Québécois. And we value this company on EV to EBITDA and price to earnings basis. So as we can see, they're actually trading at a discount compared to their peers. They're trading at a 7.9 times EV to EBITDA multiple versus an 8.8 times EV to EBITDA median. And they're trading and they're slightly less undervalued in terms of the price to earnings, where they're trading at 16.4 times PE relative to an industry median of 17.2. And we got valuations using both of these multiples, and you can see at the bottom here, our EV to EBITDA multiple valuation came up to $132 per share, and our price to earnings valuation came to $118 per share. So we also conducted a DCF for the company, and we started off by projecting revenues, and you can see that overall revenues are projected to increase at 2.5%. So this was management guidance was between 2 to 4%, and most of this growth comes from the United States. And we picked 2.5 as our base case number to be a bit more conservative, and we actually continued and went on to do an upside and downside case, which we'll get into quickly a bit after. So we projected EBITDA margins to actually decrease a bit to start off with to be a bit more conservative, and then we projected margins to increase as the years go on. And after we projected out our unlevered free cash flows, we got down to our unlevered free cash flows, and then we went to our WACC, which consists 2/3 of the cost of equity and 1/3 of the cost of debt. So for cost of equity, we used the CAPM method, and we went down from the market risk premium. And for the cost of debt, they paid an average of 4.4% on their debt, and we got a WACC of 5.9%, and we used the EV to EBITDA exit multiple and got to our implied share price of $135. So you can see our football field once again in the top, and like I said before, we did for our DCF weighting scheme, we did 50% for our base case, which was $135, 25% for each of the upside and downside, which was $160 and $120 each, and this gave us a DCF valuation of $139. And we weighted the three valuation methods that I just talked about, so the DCF, the EV to EBITDA multiple, and the PE multiple, with the DCF being 50% of our weightings, and our EV to EBITDA multiple and PE multiple consisting of 25%. And this gave us a 12-month price target of $132, which implies an implied upside of 50%.
So the two major sources of risk is the trend from wireless to wireline and the competitive landscape. Cogeco's competitors are marketing their wireless services and Cogeco's network footprint, and they're incorporating the wireless service into their bundled packages. Cogeco is not neglecting the wireless service market, they are just taking a disciplined approach to make sure that potential entrants will meet its financial objectives. In both countries, the telecommunication industry is highly regulated and faces regulations set by the CRTC in Canada. Since Cogeco is focused on acquiring companies in the US, it could face acquisition risk in terms of facing integration issues between companies, but historically Cogeco has successfully integrated their acquisitions. But after incorporating these risks, we would like to reiterate that we do have a buy thesis on Cogeco at a price of $132. Thank you for listening to our presentation.
Now we have about 10 minutes of Q&A before we get started on the next one.
So before we get into the Q&A from the portfolio standpoint, the reason I really like Cogeco is firstly, at this point we have 6% of the fund in Rogers, and over the past year it's underperformed. And then just thinking about the industry as a whole, we do need one of these players in our portfolio as our mandate states. And the reason I personally think Cogeco is a great pick is if you look at what are the key drivers in the industry, is one, branding. I think it's very important. It's, you don't really get to see and feel the service before you buy it. And so it's very important to have a good brand image. And I think over the past couple of years, Bell and Rogers have kind of ruined their brand image with the kind of service they offer. So I think Cogeco has this kind of advantage in terms of branding. They're a smaller player, and so people like that more. Secondly, as far as one of their key service area goes, which is Quebec, is that people like in Quebec, there's been this trend of using more local products and services. And I think that's another driver of Cogeco's month over month and year over year and quarter over quarter customer growth. And lastly, I think there's a strength in being smaller in this kind of market. And the main reason for that is, one, as I said before, and two, is that in terms of the regulatory environment goes, as we move forward, I think internet regulation is going to be a bigger and bigger part of the political debate. And being smaller, it kind of shields you from having the biggest, or having that regulatory eye trained on you specifically. So I think for those reasons, from a portfolio management perspective, I think Cogeco is a better pick than Rogers overall.
audience, feel free to ask questions or any clarifications.
Can you go to the revenue slide?
Yeah.
The financial model.
Yeah.
Can you tell me how you've got the top line revenues? Do you have any figures around growth, customer growth rate, number of users, ARPU, or anything like that?
So our revenue growth rates, we kind of project this out with Canada and the US, so by geographic segment. We projected the US to actually grow faster as they expand into Florida and as they continue their expansion in the US. Whereas for Canada, the numbers are relatively growing at a much smaller pace, around like 1%. So most of the growth for this company is actually in the US.
Okay. Have you broken it down by in terms of the average revenue per user or anything like that?
Coachco actually doesn't publicly disclose these numbers, so it's actually hard to find breakdowns for that.
Gotcha. Is there any reason for 2.5%? Is that to keep it conservative or?
Yeah, so management actually gave a guidance of 2 to 4% for the next 5 years, and we want to stay at 2.5% because this is our base case, so just not even at the midpoint of that. So we kept it to kind of stay a bit more conservative, and our upside scenarios projected at around 4.5%, so just above the management guidance, and our downside scenario projected revenue growth at 1.5%, so just below the management guidance.
I think last question for me would be for one of the key things that I was actually looking at this company not too long ago. I think one of the risks that management mentioned in their own earnings transcript was the build out of Bell's fiber to the home, and I think that's going to be a big competitor, potentially taking some market share away from these guys as well, because they operate in the same markets. Are you concerned about that? Has that impacted into your evaluations over here?
Do you want to take that?
Yeah, so Cogeco's overlap with Bell's FTTH footprint is actually minimal. So even so, in the markets that there is no overlap, that's when they can provide and kind of differentiate themselves and provide the high-speed internet services. So yeah, I mean, it is minimal between where in the markets where Bell offers their FTTH.
Can anyone name 3 other telecom companies in Canada?
Rogers, Bell.
Hey, non-SMF members.
Yeah.
Extra points if you're a first year.
What did you say?
Okay, that's right.
Spell, tell us.
Okay.
That was the players that we didn't mention.
Okay. Are we ready? All right. Good evening, guys. Thank you so much for coming out this Thursday night to listen to our presentations. Right now, we're going to go over to our second pitch. It's a golden presentation. It's about Torex Gold Resources. So it's an intermediate gold company that's operating in Mexico but headquartered in Canada. So we have a buy recommendation on Torex Gold Resources at a $24 target price. So just to give you an executive summary of what we have and what we will be presenting in this pitch. Again, we have a buy recommendation with the target price of $24, which is a 26% upside to our current with the current trading price. It's well positioned. This stock is well positioned for growth through its already existing projects and projects that are going to be kicking off very soon as 2022 to bring in more revenues, more cash flows for the company and reward shareholders. It's a very low cost company, so gold mining business is very simple. You buy a piece of land, you set up a bunch of equipment, you send a bunch of people there, they dig, they get the rocks, put it into the equipment that's called the mill, and then after they feed it through the mill, gold comes out and they sell the gold. That's essentially the gold mining business. And how you win in this industry is get as much gold as you can for as cheap as possible. So this company is very good at extracting a lot of gold and extracting it in a very, very cheap manner. One term that we will be talking a lot about is AISC, so it's called ASIC. It stands for All-in Sustaining Cost, and that means it's the cost it takes to mine 1 ounce of gold. So an ounce of gold is basically what it's traded in, and an ounce of gold, if it's $1,500, which is approximately what it is right now, and your ASIC is $500, you make $1,000 of profit per ounce of gold sold, and they sell hundreds and thousands of gold per year. So overall, our investment thesis is that in terms of macroeconomics, it's a very favorable gold environment. They have a very attractive asset base. They have a lot of innovation. For a small company, they're disrupting the gold mining industry with technology, which has been stagnant for decades, and it's well positioned to be bought out by another company.
So to give a just brief description for those of you who don't know about Torex Gold. So Torex Gold is a Canadian intermediate gold miner with a market cap of 1.6 billion. Compared to the larger players like Barrick Gold or Yamana, it's a very small company within the TSX composite. So it's an intermediate company, and their main office is in Toronto, but their mining operations are fully in Mexico. And they have 100% interest in a gold miner location called Morelos Gold, and they have two ongoing projects. One is called the El Limon Guajes and Media Luna. And El Limon Guajes is already a fully developed mining operation. They're the kind of the major producer of gold and major revenue producer of Torex Gold. Whereas Media Luna, they're in the development stage where they're not still producing, or they haven't really digged fully yet, so they're fully in development stage. And in terms of their reserve and capability of gold, how much gold they have right now, El Limon Guajes have almost $1 billion worth of net asset value. So compared to their market cap, their market cap is 1.6 billion, and their net asset value for El Limon Guajes is 1 billion. So that's pretty attractive. That's pretty much it.
So just a bit of clarification. So there's two mines. One mine has a value of $1 billion. The other mine has another value of $500 million. And then that's the intrinsic value of the business. The intrinsic value of the business is about 1.5 billion US dollars. And based on that versus 1.6 billion Canadian dollars, their intrinsic value of the business is more than what they're trading at. Therefore, we believe the stock is undervalued with a lot of growth potential and a lot of catalysts into the future. So in terms of the operation itself, as Kenshin mentioned, they operate in the Morelos gold property in Mexico, and which is in the Guerrero gold belt. So it's basically a region beside the capital, Mexico City, and then in there they have two main mines. The first one is the ELG complex, which is in production, and the second one is Media Luna, which is a development mine, so it's going to start producing in 2022, 2023. So ELG is a very low cost and a very high grade mine. So they have 2.3 million ounces of gold equivalent resources, which they can mine at an AISC of $800 or less than $800, and they have high expectations to increase the resources in the mine through exploration. So they're going to dig some more in other places in the property and get some more gold. Only 25% of that huge property has only been explored, and based on that 25%, they've extracted about $1.5 billion worth of value in terms of what gold is there, net of how much it costs to mine them. This graph right here is basically a cash cost curve. So this right here is where Torex Gold stands in terms of all the producers. It's a kind of a complex chart, but the closer to 0 percentile you are, the lower cost you are relative to the competitors. And as you can see, Torex Gold is very near the 0%, so they're one of the cheapest gold producers in the world.
Next, I like to highlight some of the financials that goes along with Torex. So, as Omar just mentioned, Torex is a very low-cost mining operation, and as you can see, we compared it to other intermediates that trade on the TSX, and they are in the first half of the lower comparables. Next, I like to highlight the production profile. As you can see, so in 2023, that's when Luna is about to start operating. So as you can see, their cash costs are decreasing in addition to their production as well. And we also have stable revenue growth, and that goes along with our production. And with all of that, it creates stable asset-free cash flow, and that really does support top and bottom line growth. So, and then moving on to our profitability. So as you can see, Torex does have attractive profitability and cash flow generation. So compared to our peers, Torex is able to produce better than intermediate peers along the TSX, and in addition to that, they do have high quality growth, so they do outperform peers in the industry in terms of return metrics, and this really does reward shareholders in the end. A key concern in the market compared to peers is definitely leverage. However, once we look more into that, we can see that management does have a projection for paying off their debt. In addition to that, with paying off their debt, they do have a increase in cash reserves. So TXG, they did announce a credit facility back in July, and overall it does have a higher leverage in terms of peers, but the deleveraging is pretty positive, and it's on track to generate strong free cash flow as well.
So one of the reasons why we think this stock is undervalued is market is giving it a lower valuation due to its higher than average debt position. But as Linda mentioned, they can generate free cash flows a lot better. They are producing very high grade gold at very low cost. So into the future, they can pay down debt, and again, we believe that's gonna be a catalyst for re-rating, and we do believe that the market is going to ascribe the actual value that the stock should be trading at.
Okay, so the following chart summarizes Torex's index share performance related to the events that happened with the company in the past 2 years. If you see the point B, that's when the share price started to drop after local workers started to illegal blockade, and the company had to halt their operations, and they reached bottom at point D when eventually they could solve the issue and started the operations at the original capacity. That's when the share prices went down a little bit, and from point E they started increasing the share price thanks to the technical report came out regarding the El Limon Guaje complex, and they enjoyed the peak until point G when their Q1 earnings in 2019 couldn't reach the expectation, but however they recovered the price from point H after they resulted strong Q2 earnings in 2019. So in overall, our company has underperformed related to the price of gold. If you can see, they underperformed by 10% when the gold price was about increased by 28%. But we do believe our company is well positioned for growth for several reasons. Now we're going to explain why. So for the first thesis, we think the gold outlook is pretty favorable thanks to the slowing global growth, weaker US dollars, and lower rates. We think the investors are turning into gold for safe haven investment and portfolio diversification. Linda is going to explain more about that in the future. For the second key driver of value, we think that the company has really good, attractive asset base with 25% unexplored. They have 2 very high quality mines going on that build out of Luna Media and also the extraction from El Muna Guaje. Also, they just released announcement about other exploration opportunities like involving not just gold, also diamond as well. The third key driver of value we're going to talk about, Kenshin is going to talk about Mokahi technology. It's a mining technology that helps to mine the underground mines for the Media Luna. He will mention about the benefits, the cost and time benefits that it's going to bring to the company. And for the last thesis, we think that Torex is very well positioned as a takeover target because it's trading at a low rate.
Yeah, so as Melody mentioned, 2 key things: slow global growth and political unrest. So in terms of slow global through, a few key facts out here. The United States ISF managed data. dropped, a lot of easy money policies in terms of in the United States with interest rates dropping, and in the European Union as well. So a key market play here is definitely negative yielding debt. There's a bunch of it out there, especially in the European Union. And I like to point this graph out, and it's just essentially a correlation between the gold price and the amount of negative yielding debt. So as negative yielding debt goes up, investors, they say, hey, I don't want to just put money into something that I have to pay for. They're going to go to gold. So that's essentially the argument. And then I also like to highlight the trends in gold equity markets. So there has been more excitement in gold stocks recently, especially with the gold price, and the market also calls for a new round of M&A. And there are a few reasons to investing into gold equities. First one is definitely the undervalued gold stocks here. So as you can see, compared to the TSS gold miners, and the price of gold is extremely undervalued, where it used to be pretty high before in 2011, and so we think there's a really good upside there. Next is the gold bull market is definitely just getting started. As you can see with the gold ETF holdings and the gold price there as well, there is a good correlation into that in terms of that. Next thing is that supply of gold is limited, and price of gold is dependent on the supply, so it's very elastic in that way, and that's one of the upsides there as well. And next thing is just positive momentum ahead. Very positive trends in prices and earnings in the gold mining industry, and it's really driving the hype there as well.
So just for people who are new to the gold mining industry, or like just mining companies in general, mining companies, they're all identical. Their revenue comes from how many ounces of gold they produce and what the price of gold is. And as you guys learned in econ class, there's price makers and price takers. Every single gold company, they're price takers. So whatever the market price of gold is what the revenue is going to be. So if market price of gold is up, then their revenues are going to go up and the companies are going to be more profitable. And especially low-cost companies like our company, they're going to be more profitable. So our thesis here is that gold, the actual physical gold, the value of it's going to go up into the future. And gold equities, their value is going to follow as well, and it's going to continue to follow. If you have any clarifications, feel free to ask. So moving on, in terms of the actual company, it has a very attractive asset base. So their company, as we mentioned before, they operate in the Morelos gold property, and the Morelos gold property has the two projects that we're talking about, the development project, which is Luna, and the exploration project, the producing project, which is ELG. And it has a very attractive production pipeline where the actual cash cost of producing gold, so the actual cash expenses of producing gold, is going to go as low as $222 in 2022 based on companies' engineering studies, because it's a very high, very easy to mine land. There's considerable upside in the actual property. So if you guys can see in the back, this little piece of land is the actual property. These purple spots, if you can see, are places where there's high magnetic activity, so meaning like there's high chances of gold in there, and out of all those properties, only 25% has been explored, and out of the 25%, they have two projects worth $1.5 billion, which is really, really great. And Kenshin's going to talk about this technology called Makahai, which makes the cost of mining go down even more, and it's a proprietary technology, so the cost of mining in these unexplored lands, they can go down even more. So that's another potential upside to this company. So moving on to Kenshin.
So as everybody else touched upon, the advantage of the company financially is the fact that it has high profitability, low cost, and it has attractive mining base. But another operational bullish reason is their industry disruptive technology, which is called Makahai. What it is, there's two different things compared to the conventional mining technology. One, we're utilizing an electronic monorail Two is the fact that the angle of digging a hole is going to be much steeper, which is going to be 40 degrees. Conventionally, it's 25 degrees. So what that allows you is it allows you to achieve three key benefits. One, in terms of the short-term reasons, up to 30% of reduction up from capital expenditure. Because the length of the drilling is going to be much shorter, it allows them to reduce a significant amount of initial costs. The second thing is up to 30% reduction in operating expense. Conventionally, they don't use monorail, they use like a truck or LHD, and that usually takes manual work. But now with the electronic monorail, it allows mine to automate the transportation process, and also everything else is driven in electricity, so that allows them to reduce their long-term operating costs. Another two bullish reason is up to 80% reduction in time until production. So time between them investing and actually producing gold, it's going to be reduced like significantly. And lastly, up to 95% reduction in GHG emission, greenhouse gas emission, because we're utilizing heavily the electronic monorail, we're able to achieve environmental benefits as well. And as you can see,
So it's a significant upside to our valuation, but since it's still currently patent pending and they're still going to the final stages of testing, I didn't incorporate any of these cost reductions into the financial model. So once it does happen, our value of the mines, the value of the project is going to go down substantially. So all of this is pretty complicated work, and I don't think any of us are engineers or like geologists. So Kendra, do you want to just explain it in like one sentence, like what it really is and what it means? What it means is it's going to reduce costs for mining, but what is it really?
Like in terms of what the
technology is.
The technology is really simple. Like all the conventional mine, even the big gold players like Barrick, Yamana, they all still use truck and manual like actual driving process when they're like transporting people, supplies, even gold ore. So now with this electronic monorail, it allows you to just like less manual work, and like something that I've already touched upon. It's just basically reducing costs, reducing manual work, and these two, not really financially beneficial, but it's environmentally beneficial.
So we believe Torex is a great takeover target. If you can see from the graph on the left side, Torex is trading at a discount at 0.78 times PNAV compared to the peer average of 0.98 times PNAV. And also, we listed down potential acquirers. They're all trading at higher multiple than our company. And overall, we believe that Torex is a single asset company, operates in Mexico, and has a very good quality assets, low cost. We believe it will add definitely value to any acquirer.
So in terms of valuation, we have employed a net, one of the three main valuation technologies, or methodologies I should say, is a net asset value model. The net asset value model essentially takes into account how much gold they will produce into the life of the mine, how much it costs to produce that gold, so the expenses, the capital expenditures, and with that you get your free cash flows, which is basically the free cash flows of the mine. The blue free cash flows is the current project, ELG, and the gray ones are Media Luna, and the present value of that gives about $1 billion, $1.5 billion US dollars, and you have to make adjustments for like corporate expenses and their net debt to come up with the equity value. And with the equity value, you multiply with the multiple based on its peers, and with that we come up with a $21 valuation with just the NAV alone. If we look at the comps, I'll keep it very simple. For almost all of these comps, Torex is trading below its median, and because of that, we do believe that Torex should be trading at a higher multiple. So the Torex PNAV that's based on the street is 0.79, and their PNAV, which is the main multiple used in mining, is 0.88. EV to EBITDA, for example, is 4% or 4 times here. The median in the industry is 6.5. So if they were to trade like their peers, they would be their stock price would be a lot higher, and we do believe that they should trade like their peers because of the near-term catalysts. So in terms of its valuation, we have a 70% weighting from their PNAV, 6.5 times, and we applied a 1.1 times multiple to it, which is around the higher end, 75th percentile of its peers, because we do believe they make more money, they're lower cost mines, so they believe they deserve a premium valuation. but the EBT bit and price to cash flow, we priced it at just at median or just below median, and with that we came up with a $24 price target, assuming a 26% upside. And we actually picked the stock when it was trading at $17. Now it's trading at $19, so much of that upside has already been realized, but there's still 26% more that we could realize in the next future. So our recommendation is that we are recommending a buy at $24 within the price range of $16 to $18 for entry, and the Q4 earnings, updates on the mines, updates on the technology, and extended mineralization of the current project are near-term catalysts. Some of the risks, Melody is going to go over it very, very quickly.
Yes, so we have major concerns around the labor because the illegal blockade that I mentioned actually halted the operations historically, but the company has been doing a lot of initiatives to decrease that, to prevent that in the future. For the single asset producer risk, we actually use the higher interest rate into our valuation. For gold price and exchange risk, it's shared by every peers. We think they should keep going with their gold protection program that they're using right now. And for the high leverage, they're slightly over leveraged, but we think they're gonna pay down the debt by 2020 with their strong cash generation.
And thank you very much. That is it for our page.
Just a quick note on the portfolio management scene again. First of all, we don't have a miner or any mining company in our portfolio at this point, and so we've kind of been forced to put our money in an ETF to kind of simulate that. So I think it's great that we actually have a pick now. Secondly, if you guys remember to my presentation at the beginning, the key things that we're looking at right now is first of all looking at more defensive stocks, just in case of the economic downturn. And I think gold doesn't get any better or more defensive than gold. Secondly, we look at asymmetric risk, and I think in our presentation today we saw multiple examples of that. So one, the new technology that gives us potential upside. Two, the second mine that's coming online. And the third thing that we really focus on, we're focusing on right now, is kind of really bread and butter solid companies. And this company, I think our presenters have really proven that today, which is they produce gold at very low cost, and they're able to sell that gold for a great profit. And I think one note going into the future, which kind of gives me some more confidence to invest in this company, is the fact that going forward, they've noted that they're going to hedge 25% of their production using a costless collar with 1,400 and 1,700 strike prices. And I think, again, that kind of gives us some downside protection. So a lot of upside, a lot of potential upside, limited downside risk, trading very well in the market, and I think it's a wonderful thing for our portfolio.
Yes.
Okay, so I was just doing a quick Google search of the company because I have not heard of this company before. And I looked into some of the labor issues that you guys mentioned, and they're pretty significant. And I'm just quickly Googling, like 5 people died last year, were murdered by striking workers were murdered by security teams. So calling it an illegal blockade is questionable, first of all. Second of all, the reasons these people were protesting was for unfit working conditions. Hang on, let me find the thing. It says they were executed gangster style on November 18th, so like 1 year ago almost today, in the presence of their fellow workers and own families. So that to me is like a really big red flag, and I don't know if there's anything that the company can do to make up for that. Also, so some of the other things that I was reading were around environmental issues, like the company hasn't done their proper due diligence for taking care of the community from which they're taking these resources. So this is an issue for mining companies, period. I'm just wondering how you guys think you can bring this into the portfolio, knowing that those things are occurring, and how do you justify that, the moral and ethical obligation that you have?
So actually the legal blockade that you just mentioned happened from November 2017 to April 2018. It kind of involved 2 quarters, and then they actually halted down the whole operation 100% so that the police would they also worked with the government because the illegal blockade issue came because some of the workers wanted to displace their current union, but Torex have actually had no authority to change any unions because it required some government related sanctions. They would have to look into the intentions and then consider what the majority of unionized workers are thinking to do that. So the bottom line from that case was they dropped the case to change the union because they couldn't change it. I think they couldn't come down to negotiations themselves, the employees. That's why they stayed with the original union. And after the event happened, they actually signed community development agreements with 11 local 11 local communities to help them to improve their communities and also build trust and engage a healthy relationship. So in those agreements, they state what are the commitments that Torex will go through over the period of time, and then what are the PKI, the key performance indicators to see the efficiency of the agreement. So that's what they're doing right now.
In terms
do you think that's enough? That justifies us having this in our portfolio? Do you think what they're doing is enough?
in terms of, I guess, gold companies in general,
Like Barrick Gold, there's nothing worse.
yeah. So,
Right.
for example, like companies that are operating in LATAM, ex-Chile and Peru, and most of Africa, the approach that they had in terms of government and community relations were more with the federal and state government. So they would, Barrick Gold CEO or the chief exploration officer would just meet with the minister of natural resources, wine and dine, and get the concession for pennies on the dollar. However, recent trends like late 2010s, these mining companies, they're realizing, especially in Latin America, that you have one government, one minister of natural resources, but taking a community approach is a lot more important. And unfortunately, Torex did this after a negative catalyst, but they are taking a more community approach to government and public relations. So we do think the risk of the same thing happening is much, much, much more mitigated. So they're working with the community a lot more.
Also about the environmental factor they mentioned, we didn't really touch upon it, but the fact that this Mukaki is more the reason why, even though these two reasons below, it doesn't, I mean, like this does, but, I'm sorry, don't touch it. The fact that it reduces the amount of, there you go. Greenhouse gas emission, I guess.
Thank you. How do you click that? Okay. Hi, everyone. I mean, quite a turnout, so thank you so much. We've got 5 people pitching today, so it's a little awkward for which side I should stand on. But nevertheless, this is the consumers group. My name's Sabi, I'm the portfolio managers, and the analysts will be?
Richard, I'm one of the analysts. My name's Ibrahim.
Yarrow. And Jeremy.
And today we'll be pitching Empire.
Sure, I'll start off. As I said, we're pitching Empire Company Limited, one of Canada's largest food retail conglomerates. We have a buy thesis with a target price of $45, which has an implied upside around 31%. We'll start off with a quick qualitative overview of the company and the industry it operates in. We'll review its recent financial performance and then dive deep into our actual investment thesis. We'll end up by explaining the valuation models we use to come up with the target price and then lay out the risks associated with the investment.
All right, so as Jeremy mentioned, Empire is a grocery store operator, and you may know them by some of their brand names such as Sobeys, Safeway, Freshco, and the new addition is Farm Boy. And so they operate in a very marginally tight environment where the profits are a very low percentage of their top line revenue. So cost efficiencies are very important in this industry. And the current management team is very experienced and very well respected in the various industries, and they have been improving operations of the company and really setting up and preparing it for further development through multiple initiatives they've been implementing. One of which is Project Sunrise, and which focuses on reducing SG&A, and as I mentioned, it's a very big part for improving margins. So furthermore, they have also been expanding into Western Canada with their discount stores Freshco's, and buying up Farm Boy, which allows them to penetrate that premium market for food retails. Furthermore, they're in the defensive industry, which will allow them to flourish in many economic cycles, regardless of where they are in the economic cycle. And overall, we therefore give them buy target with $45. And you can see some of our valuations up top. And I'll pass it on to.
So in terms of what Empire is and their story, so Empire was founded in 1963 and operates through two main revenue streams, which are food retail, so essentially grocery, and real estate through their subsidiary Crombie REIT. Now, out of those two streams, food retail takes up 91% and real estate takes up 9% of their top line. And in terms of the food retail, that comes from 6 of its main banners, which are Freshco, Foodland, IGA, Sobeys, Farm Boy, and Safeway, which operate in premium, discount, and everything in between in terms of those markets. So we're talking about the story of Empire and why we're really attracted to it. So it starts off in 2016, where they're going through a really, really rough patch. Their Safeway acquisition integrated horribly. They had to impair it by half of its value, as well as they were experiencing negative same-store sales growth in their stores, and their CEO had resigned from the company. Fast forward a year, they find their new CEO in Michael Medline, and he hires CFO Michael Vels, and together they begin Project Sunrise, which is essentially a cost savings and stabilization focused initiative to help get Empire back on the right track and lay the foundation for future growth. So looking back on the past 3 years of this project, it's coming to the tail end. And we can see that the growth that's happened from it has been phenomenal. So they've made a lot of key moves to lay the foundation for them to compete now. So they acquired Farm Boy for $800 million. They ventured into AI e-commerce platforms and partnerships with the Ocado Group. And they've really exceeded their Project Sunrise expectations in terms of like what they've delivered. As well, they've also announced their Freshco expansion into Western Canada, so that's something to look forward to as well.
All right, so as Ibrahim mentioned, they hired the new CEO in 2017, and he's been really reforming and bringing this company up to speed with their competitors. So he brings a lot of experience because he was previously CEO of Canadian Tire, where he successfully implemented their loyalty system, integrated into an app, which complemented their Canadian Tire Money. He has also gone through the acquisition and operation of a company during that time, and he further improved the implementation of technologies at their stores, which allowed online ordering and pickup at the stores, which Canadian Tire has not done before. He also brought on the Michael Vels, who has been previously the CFO of Hydro One. He was the key player in Hydro One going IPO and becoming more commercial focused, commercial and investor owned. And he's been able to implement a lot of cost reducing strategies and efficiency strategies that he implemented himself in the company, which is one of the key areas and the key things he was able to help with the Project Sunrise. There's also Pierre St. Laurent, which has been with the company for a very long time, has been in many executive positions ever since graduation, really. And he pretty much knows the business in and out, and we believe that these gentlemen will be able to drive the performance of the company going forward. And as you can see from the share price performance and when they were appointed, it looks like the market agrees with us. So moving on.
So I'm just going to go over the industry that Empire is part of. Empire is part of the Canadian grocery industry, which is a very robust and defensive industry. And then it's in its very mature stage and expected to grow in the next 5 years by 0.3%. And in this industry, there's a fair bit of competition. So in its internal competition, it includes players such as Loblaws and Metro. And the way they compete with each other is by price reduction or by loyalty programs. So the external competition part is also intensifying as time goes on.
Costco and Walmart are also entering into the retail space. And as we look at the type of spending that goes into this industry, so the income quintile, what I mean by this is that there are high-income families spending in this industry, and then there are the second highest income families spending in this industry, and it's very spread out. So that's what makes this industry very defensive and very stable, very dependable. And the companies in this industry, they're growing in the long term by investing in their operations and reducing human and labor inputs. And they're also advancing through other technology advancements, such as online shopping, omni-channel shopping to consumers as well.
Right, so as we mentioned, 2016, 2017 had very poor performance, ineffective management, bad Safeway performance, as well as increasing SG&A had a very deep negative impact on the bottom line margins. However, for the last 3 years, the new management team has implemented several initiatives that have been focused on decreasing costs and increasing revenues. Main one, which we've mentioned before, Project Sunrise, was focusing on restructuring the organization as a whole. And initially, it was estimated to save $500 million over 3 years, but actually has outperformed itself due to a successful implementation. So in 2019, it incurred an incremental $50 million in savings, and now the cumulative estimated savings are $550 million, $250 to be incurred in this fiscal year of 2020. And paired with this is stabilizing revenues. So what Project Sunrise also did was something called category resets, which is meant to focus on the consumer needs and preferences. And with cost savings and stabilizing revenues, we've seen their EBITDA margins recover over the last 3 years. Comparatively, although our gross margins are still lower than our main competitor of Loblaws, because we're better at controlling our SG&A, the returns on our assets and equity have improved greatly. Year over year was 131%. And then overall, positionally, this is why we believe we have great growth potential. With the cost savings and the stabilization, now management can focus on initiatives that drive revenue, which they have several projects lined up. And that's why we believe in the future they'll experience enhanced profitability.
So in terms of the rationale and why we believe that Empire is like a solid buy for us is because now they're a stable company. They really weren't back before Michael Medline was appointed, but now they've found positive same-store sales growth. Their EPS has slowly become more stable and has grown. And that's also helped by the fact that they're in a very stable and defensive industry that helps them to deliver really robust performances shielded by certain, like a majority of macroeconomic factors. So, I mean, because of course, everyone has to get groceries no matter what. And all of this is really helped by the fact that they have a proven, tried and tested management team that's helped to guide them through the rut that they were in. And now they're at the forefront to bring about more value and change. So this is a challenge that we believe that they're up to and are fully capable of doing. And in terms of the changes that they are going to make, they're going to really aggressively expand the business now that they're stable and drive a lot of earnings growth. So right now, they're planning on expanding into Western Canada through FreshCo to lead a sort of discount expansion through that banner. So they're planning to open 65 stores in the next 5 years, 18 of which are going to be put up within the year. They're also going to be converting 25% of those poor performing Safeway and Sobeys that are in those locations and converting those into FreshCos. Now, in terms of their Farm Boy business, they're planning to double those the store count from 26 to 52 stores in the next 5 years in order to take advantage of the more metropolitan areas in Ontario and their willingness to pay more premium amounts for more quality food that Farm Boy really specializes in delivering. And to cap it all off, they're also forming a partnership with Okada, which is a British AI e-commerce platform, which could really help them level the playing field in e-commerce with Metro and Loblaws. And they're going to begin their soft launch next spring.
Now, to kick off the evaluation, I think it's really important to kind of also for time's sake as well, to kind of cover the higher level assumptions that were taking place to kind of come to our evaluation. For one, it's revenue. Now revenue, it's inspired primarily by the organic same store sale growth, meaning we're not looking at their M&A strategy 100%, we're looking at how the business as a whole can grow. And that's the backbone of our projections for revenue, which are fundamentally very, very stable. It's important to note that I've separated the core top line revenue, meaning their grocery revenue, away from their revenue from Cromie REIT, which is their REIT subsidiary. In addition, margins are not set to expand. That's the way it's set right now. And as previously talked about the acquisition of Farm Boy, the further investments into luxury groceries, we are expected to see margins grow. So with this idea, you can understand that the assumptions are relatively conservative, but still, nevertheless, we do reach a premium of 31% on top of the current last close price.
Right, so for the valuation itself, we took a comprehensive approach, rationally distributing weight between the DCF and the comparables. For the DCF, we gave a 55% weighting, and the comparable we gave 45%. We give the DCF a slightly higher weighting because it more accurately reflects the future profitability and cash flow generation of the company. For comps, we chose industry-relevant multiples, price earnings, EV over EBITDA, and EV over revenue, and overall came up with a final target price of $45.19, which has an implied upside of 31%, which we believe appropriately encompasses the new management team, Project Sunrise, the new e-commerce capabilities, as well as future growth.
Right, so moving on to risks. This company has very common risks that are pretty much applicable to a lot of other companies. First of all, we have economic risk, and obviously, as disposable income may change, consumer preferences may also shift. However, we believe that Empire is very well established. They have expansion of their discount stores in the West. They have their premium stores all over Canada, and regardless of what economic cycle we're in, we believe that they're well established to take on any economic risk. Moving on, we have a competition risk. So once again, this is very highly dependent on consumer preferences, and it seems like consumers don't like going and shopping. So they keep ordering food online, and this is why everyone's expanding into e-commerce. So this is something that Empire has been very successful in because they're partnered with Ocado, which is, number one, is considered the pioneer of online food ordering and delivery. They're based in the UK, as Ibrahim mentioned, where about 7.5% to 8% of all food orders are done through online, compared to 2% in America, which means they've been around, they know their way around the business. They have so much experience when it comes to online ordering and delivery, and we partnered with pretty much the world-leading system, the world-leading business. Ocado will give them advantage and will allow them to stay ahead of the competition. Now, for some of the development risks, as mentioned, there's a lot of initiatives that are going on right now. So we have the Project Sunrise, we have acquisition of Farm Boy, we have Ocado again, and the reason we believe that the company is well set to successfully integrate all of these is because of this management team. As I mentioned earlier, they have a wide variety of experiences operating in their new acquisitions, implementing cost-saving strategies. And for example, Michael Medline, again, he implemented online ordering at Canadian Tire. So this is something he can help Ocado out with integration into Empire business. And so we believe that considering all of this and considering how strong the management team is, how experienced they are, we are very well established to perform robustly in any sort of an economic environment going forward.
Yeah, absolutely. And really just to add to it and kind of speak a bit more high level, one of the larger concerns in general when it comes to the grocery industry is competition. There's a whole lot of competition. It's definitely expanding in terms of their core presence and footprint. But it's really important understanding the dynamic of this competition. The grocery industry is becoming a bit more polarized in terms of where you want to go. Branding is becoming incredibly critical. And Empire composes of an incredibly strong portfolio, right? Even if you look at discount brands, includes Freshco, has a very strong presence. And some of their newer items in their portfolio, including Farm Boy, capitalize on this whole luxury grocery segment, which not only do you see strong segments, You see strong retention and definitely strong growth prospects overall. As to kind of summarize how they're combating competition risk in general is really just sustaining the quality of their portfolio, the strong presence, and this is exactly why we feel like paired with a very strong management team, we feel like Empire is really well positioned and really leads us to our core recommendation of $45 based on our evaluation, which is a 31% premium to the last closing. So thank you so much for listening to today's presentation for consumers, and yeah, thanks.
We actually don't have a grocer in our portfolio at the moment. We have other companies like Maple Leaf and Saputo, and so this is the first foray into groceries. And this is kind of the stance that the fund has taken, that Empire is established better than Metro or Loblaws.
And more than happy to have any questions here, any questions. And once again, we obviously invite the input of any individual in terms of Empire.
Can you just comment on the health of the balance sheet, particularly the debt levels?
Yep. Oh, debt levels.
Yeah, relative to competition.
Yep. So, well, it's not explicitly listed here right now. Fundamentally, the cap structure is very diverse among its competition. It's really unique based on the companies. In terms of Empire themselves, like they are decently weighted on debt overall, but pardon me?
7 billion.
Yes, a whole lot of it. But once you actually dive into the debt itself, you realize that a whole lot of it is a whole lot of term loans, so a lot of senior debt, and fundamentally they have a very low reliance on operational debt, which brings light to kind of like a stronger core business from an operational standpoint.
I have 2 comments, rather not questions, rather comment. First on the color. I don't know, is there a reason why you picked green?
It's Sobeys.
Okay.
That's their
But
company.
just for everybody else as well, like when you're doing a chart like that, it's kind of hard to see differences,
Which one,
especially for some people who have a problem with colors.
Oh yeah.
So I can't really
Apologies.
tell
Yeah.
which company is which when I'm looking at this bar chart because they all green. So if you're presenting, it's good to have a higher contrast. And the second comment is in line with what Ois was asking. For a mature company like this, it's actually good to see the balance sheet and actually compare them with the competitors. Especially you guys have reiterated so many times that this is a very competitive industry. So I'll be interested to see how expensive this company is. Meaning that is there a comparison in PE or any of the balance sheet items that can be comparative to the other competitors. So it's just a comment.
No.
So it'd be
That's
good to
very
see
fair. You're right, and I agree with you.
I mean, I can show them the comps if you want. I think traditionally, if you go to the last appendix, actually, they included that they're traditionally Empire is underpriced in almost all the comps, which is why we think it's actually better than Metro, because Metro right now, all the grocers had a very good season and great performance, and actually Metro, we actually think is overpriced. They had that Jean Coutu acquisition. However, most of their metrics we believe are already priced in. So although Metro is a great company, we believe investors have already priced it in. Well, versus with Empire, since it's under trading most of the multiples, we think right now is the prime opportunity to invest in it.
I have a question. This is just like a straight up question. Is Farm Boy meant to be their version of Loblaws or their version of Whole Foods? Like, what is Farm Boy? Like, as a consumer, Farm Boy is crap. It's expensive, and it's the same as Food Basic, or it's the same as Foodland, which is down the street from me. I would never shop at Farm Boy again. I looked in there, I was expecting organic beauty, and I was like, what the heck? So what is Farm Boy?
Yeah, I don't shop for groceries myself, but
Lucky for you.
But like when doing research, quite frankly, I wanted to learn more about what Farm Boy was
Yeah, what is Farm Boy?
in the summer light. It's relatively niche, and they have like a whole lot of, for one, strong returns, strong retentions, and they focus on kind of a niche in terms of the specialized products that you can't find in many other groceries. So they have like strong, committed, I guess, suppliers for these particular products. And although once again I don't shop for groceries, I guess you didn't have an appeal for their products.
I was like, no, it's not gonna
Yeah, it's just, I guess there's
not in Toronto.
there's a, I guess,
Try shopping online.
yeah. I mean there
Maybe
is
one in Ontario, but
there is a committed consumer group in general, a niche that they've capitalized very well on. And that's translated to one, not only the strong growth, but strong penetration within the markets that they're competing in. Yeah.
Thanks. I was just
Yeah, no worries.
Can you just go back to the football field?
Well,
I
yes,
noticed
right here.
that a lot of the upside is coming from metrics that are 1 to 2 years in advance, 2 years in the forward. Sorry. So A, how much visibility do we have on that? And B, I noticed that EV revenue is weighted at 20% when it's clearly the outlier in the football field. Given that this is a mature company, there's no need to really use EV revenue. They have positive EBITDA. Any reason why it's 20%? That definitely pads up the valuation substantially.
Yeah. I'm going to talk on weighting, and then Richard's going to talk on kind of the forward-looking between year 1, year 2, year 3.
Yeah.
In terms of the weighting themselves, I just wanted to fundamentally kind of play a larger weight on the comps in general, so 55% of DCF, and then I had 45% of essentially disposable weight among my comps. We did feel that overall, PE is relatively strong and EVs is strong as well. It just felt that at least with an EV revenue, we just saw a lot more visibility within the numbers that we had versus EV EBITDA, where we kind of had those forward-looking numbers. I just want to be a bit more careful on applying weight to those. So that was kind of my rationale. But in terms of year 1 and year 2,
year 1, year 2, looking forward is that the management is actually going through a process called Sunrise 2.0, which means they went through Sunrise to recover the company from 2016 operation, and then now they're going onwards to make the company grow again to outcompete its competitors. So I went through their earnings calls repeatedly. They said they're going to have very aggressive goals for Sunrise 2.0, and also they're actively expanding into other markets with their Fresh Go Planner, which do put a big emphasis on their ability to drive different initiatives to grow its business. Yeah.
Are there any more questions? Not too sure.
Questions? Not.
All right.
I just wanted to say thank you to each and every single one of you for coming out tonight to our first ever public pitch. I know it is late on a Thursday night, so thank you so much for sticking around. There's a bunch of food left, a bunch of coffee left, so please feel free to help yourself, take as much as you want, make sure the trays are clear. And in terms of further involvement, I know in the kickoff session and today we mentioned the mentorship program. Over the last 2 or 3 weeks, our resources have been dedicated towards creating the pitches, but within the next week or 2 or so, we're going to kick off the mentorship program. So by the time exams and winter break rolls around, you guys will have a full working relationship with the paired up mentor. So start thinking about what you guys are interested in, whether that be like investment banking, sales and trading, research, working in a hedge fund, and we will make do with our with our senior members and our junior members, and we'll pair you up accordingly. So again, thank you very much for coming out. Thank you very much to our board and our guest members for coming out as well.